Welcome to the deep dive. Today we're going granular, looking into the mind and the playbook of a true legend.
We're dissecting the Q3 2025 portfolio filing from Stanley Druckenmiller's Duquesne family office, all $4 billion of it.
And this isn't just a list of stocks. When you really get into it, you see it's a macroeconomic thesis laid bare.
It absolutely is. And the signal for this quarter is, it's stark. The man who arguably rode the AI infrastructure wave better than anyone has just performed a massive, decisive structural rotation.
The scale of that rotation is what really grabs you. We're talking about a huge pivot away from, the pure semiconductor trade, the AI hardware boom, and into something new.
He's moved into a very deliberate barbell strategy. On one end, you have things like biotechnology, and on the other, applied AI and good old-fashioned industrial capacity.
He's basically shifting from selling the picks and shovels in the gold rush to owning the most efficient gold mines.
That's a perfect way to put it. But the most astonishing number, the thing that tells you everything about his mindset, is the activity.
Yeah, let's talk about that. In a single quarter, he had 65 total holdings. He added 29 new ones.
And sold out of 33. Completely.
Which results in a 92.3% quarterly turnover rate.
It's unbelievable.
I mean, that's not investing, it's surgical. So given that staggering level of activity, what's the philosophy? What's the foundation that lets him make these huge high conviction calls so quickly?
To understand the portfolio, you have to understand the man. Druckenmiller became famous as the brain behind the trade that, broke the Bank of England back in '92.
The $1 billion trade.
$1 billion.
Yeah.
But he's not really a stock picker at heart. He is arguably the greatest macro trader of his generation. We're talking 30% average annual returns for 3 decades with no down years.
That kind of track record only comes from having a very clear set of rules. Let's start with his first pillar. Liquidity is king.
Yes. This is the lens for everything else. He has this famous quote, "Earnings don't move the overall market. It's the Federal Reserve Board." He's always focused on the movement of liquidity.
So what does this frantic rotation tell us about his view on liquidity right now?
It suggests he's wary. It implies he sees a world where that easy money, that liquidity, might be tightening up.
Yeah.
So he's shifting into companies that can win on their own merit, through their own innovation, not just because the market tide is lifting all boats.
And he can make those specific bets because of his second pillar, which is the doctrine of concentration.
Right. He famously rejects diversification. He sees it as a hedge against ignorance.
He's more of a Mark Twain guy. Put all your eggs in one basket and watch the basket very carefully.
Exactly. And the Q3 data just screams this. His top 10 holdings make up 53.3% of the entire portfolio.
Wow.
But you can't have that kind of concentration without the third rule, which is the most critical one he learned from Soros. It's the idea of being a pig.
Which sounds bad, but what does it mean in practice?
It means you go huge when you're right. You size up aggressively when your conviction is high. But, and this is the key, the absolute second your thesis breaks or the risk-reward changes, you get out immediately. No ego.
And that explains the 92% turnover. It's the only thing that does. It's why he can make a fortune on a stock like NVIDIA and then just walk away.
Completely. Which brings us right to the portfolio's current design.
Yeah.
This Q3 2025 barbell strategy.
Right. It's a structure built for an uncertain world. It has one foot planted defensively and the other swinging for the fences.
That's it. The defensive anchor is huge. Almost 30% of the portfolio is in healthcare and biotech. That's growth that isn't tied to GDP, it's the ballast.
And the aggressive wing is where he's looking for that real upside. High beta tech like Amazon and Meta, plus some global plays like the emerging markets ETF and regional champions like Coupang.
But the biggest tactical shift, the thing we have to really dig into, is the AI pivot.
He's sold out of NVIDIA completely.
Completely. The thesis here is pretty clear. The pick and shovel phase of the AI gold rush, selling the chips, the raw infrastructure, has gotten too expensive. The easy money has been made.
So if he's not buying the shovels, where is he digging? Why exit the most obvious winner of the last few years?
Because the value is moving up the stack. It's shifting from the infrastructure to the application layer. He's now buying the companies that are using all that computing power to become insanely efficient.
Like Meta for ad targeting or Amazon for logistics.
And most importantly, a company like Natera for genomic analysis. The next big wins will come from proprietary performance, not from selling what's becoming a commodity.
That focus on application brings us straight to his highest conviction zone, healthcare. I mean, the fact that his top 3 positions are all in this one sector, it's a massive statement.
It's an overwhelming bet on bioinnovation as a secular growth theme.
So let's start with the crown jewel, Natera, ticker NTRA. It's 12.74% of the portfolio. a huge position.
Natera is all about a paradigm shift in how we monitor cancer. They're leaders in cell-free DNA testing, which you might know as liquid biopsies. Specifically, their platform is called Signatera.
Okay, so for those of us not deep in the genomics world, what is molecular residual disease, or MRD, and why is finding it so revolutionary?
So MRD is basically the tiny amount of cancer cells that can be left behind after treatment. Historically, you'd wait for a CT or an MRI scan to see if the tumor came back.
But by then, it's already grown back to a visible size.
Exactly. Signatera is different. It tracks the specific mutations of a patient's tumor in their blood. It can detect recurrence months, sometimes years, earlier than an imaging scan. That's a game changer. It's becoming the standard of care.
And it creates a moat. With over 12 million tests processed, they have this massive data set that just makes their tests better and better. It's a network effect.
It's a classic defensible business transformation. Now let's look at number 2, Insmed, or INSM. This is almost 9% of the portfolio, and he upped his position by over 7% this quarter.
The conviction here seems really clear. It's tied to a single de-risked event.
It is. It was the FDA approval in August 2025 for their drug, brensocatib, which is being sold as Brinsupri.
And this was a big deal because
It's the first and only approved treatment for something called non-cystic fibrosis bronchiectasis, NCFB. It's a nasty chronic lung disease. Affects about 500,000 people in the U.S. alone who, until now, had 0 approved therapies.
So the thesis is just a massive unmet need.
That's the bet. Some analysts worry about, commercial launch execution, but Druckenmiller is betting that when you are the only solution for 500,000 desperate patients, the market penetration is going to be incredibly steep. The risk has moved from the lab to the marketplace, and the stock hasn't caught up to that reality.
So we have 2 high-growth plays. The third leg of this healthcare stool is Teva Pharmaceutical, TEV, an 8.5% weight. This one feels different. It feels like a value play.
It's a classic turnaround story. A good company with a bad balance sheet. Teva was crushed for years by enormous debt and that whole opioid litigation mess. Right. By 2025, they've basically settled the legal stuff and are now just aggressively paying down debt.
So it's a deleveraging story. As the debt shrinks, the value of the equity expands because more of the cash flow goes to shareholders instead of debt payments.
That's it, exactly. Plus, their specialty drugs like Austedo are growing, and they're a giant in the biosimilars market. It's a cash-generating machine that nicely balances the more binary risks of the pure biotech bets.
Okay, so let's pivot from the biological to the digital. Even though he rotated out of chip designers, he kept one critical holding. Taiwan Semiconductor, TSM. Still over 5% of the portfolio.
TSM is the ultimate toll taker. It's a de facto monopoly on the most advanced chip manufacturing.
Yeah.
It doesn't matter if the ultimate winner in AI is Amazon or Apple or someone else.
They all have to go through TSMC's factories.
They all pay the toll. It's a much safer, more reasonably valued way to play the long-term growth in computing power.
And speaking of Amazon, he was a new buyer there and also in Meta platforms. How do you square Meta as an efficiency play when they're still pouring billions into the metaverse?
That's the key friction point, isn't it? The bet isn't on the metaverse. The bet is that right now, Meta is the cheapest mega cap stock out there.
Okay.
And the conviction comes from Zuckerberg's whole year of efficiency push. They are using AI right now to make their core ad business dramatically more profitable. That's the driver for the stock, almost regardless of what happens with the metaverse long term.
Okay, let's switch to his global view. He's not just buying a broad index. He's targeting very specific winner-take-all regional monopolies.
Exactly. Look at Coupang in South Korea. They basically won that market with their incredible logistics, their dawn delivery model. And now that the heavy spending phase is over, their margins are exploding.
And they're exporting that model to other places, like Taiwan.
Right. And then you have Mercado Libre, or MELI, in Latin America, which is really 2 dominant businesses in one.
The e-commerce platform and the fintech arm.
That's it. Mercado Pago, the fintech part, is essentially a digital bank for the massive unbanked population in Latin America. It's growing faster and has higher margins than the retail business. It's a monster compounder.
Let's move to the physical world for a minute. He made a big addition to Wabtec, the rail tech company, up 77%. This smells like a green friction trade.
Rail is, by a huge margin, the most fuel-efficient way to move freight. As supply chains move closer to home and the world tries to decarbonize, rail just becomes more and more important.
And Wabtec provides the tech to make it all work.
And they have an $8 billion backlog. That gives you incredible visibility into future earnings, no matter what the economy does in the short term.
One of the most interesting new positions, for me at least, is Figure Technology Solutions, FAGR.
This is a fascinating one.
Yeah.
Figure is tapping into a huge problem in the market right now. You have millions of homeowners with record-high equity in their homes, but they're locked in to these super low-rate mortgages.
They don't want to refinance and lose their 3% rate.
Of course not. So Figure uses the Provenance blockchain to totally revolutionize how you get a home equity line of credit, a EPLOC.
Why blockchain? What's the advantage?
Speed. The blockchain is an unchangeable, instantly verifiable record. It cuts the approval time for a EELOC from weeks doing title searches, all the old legal stuff, down to just minutes.
Wow.
It's a pure bet on the real-world utility of blockchain to make a huge financial market faster and cheaper.
All right, finally, we have to talk about how he protects the portfolio. The hedges. He's got the emerging markets, ETF, EEM, and some options on the S&P 500.
The EEM position is really a dollar hedge. Druckenmiller has been very public about his concerns over the U.S. fiscal path and national debt, so betting on growth outside the U.S. is a way to position for potential dollar weakness.
And what about the call options on the SPY and the IWM, the Russell 2000?
That's a classic melt-up hedge. It's defined risk exposure. It lets him participate if there's some kind of, irrational liquidity-fueled rally in the broad market.
Without having to sell his favorite stocks to buy the index.
Exactly. It's a cheap insurance policy for being wrong about a market top. It lets him stay concentrated.
So after all that, what's the big takeaway for you, the listener? Let's try to synthesize this. The core conclusion seems to be that the era of just buying the market, of broad beta, is over.
It's completely over. We are deep in a market of dispersion. That means the winners and losers are going to be driven by company-specific factors, not the overall market direction.
Alpha is now about identifying these unique, idiosyncratic business transformations.
Absolutely. The playbook is simple, but it's not easy. You're betting on curing disease with Natera and Insmed. You're optimizing global logistics with Coupang and Wabtec. And you're owning the new efficiency platforms like Amazon and Meta.
So the takeaways are pretty sharp. 1, healthcare innovation is the new secular growth engine. It's not tied to the economy.
2, in AI, the smart money is rotating from the hardware to the application layer, from the chips to the platforms.
And 3, globally, you hunt for those winner-take-all monopolies that can deliver predictable growth in their specific regions.
Which brings us back to this fundamental tension in his whole philosophy. Druckenmiller's foundational belief is that liquidity moves the market. That's the macro view.
But his portfolio is the definition of micro, overwhelmingly concentrated in companies with very specific idiosyncratic catalysts, a drug approval, a genomic breakthrough, a balance sheet repair.
So we'll leave you with this question to think about. In a volatile, tightening environment where that tide of liquidity isn't lifting every boat anymore, is this the only way left to win? Is identifying these specific micro-level transformations now the best, or maybe even the only, defense against all the macro noise?